Well, hello and welcome to this Professional Advisor webinar, which brings together some of the UK's leading enterprise investment scheme experts to discuss the implications not only of the autumn budget, but the government's response to the patient capital review. In particular, what it means for investors in the EIS space and those who advise on it, and how it might change their approach to tax-efficient investing and tax planning. I'm Julian Marr, Editor of Professional Advisor, and working our way down the line, our guests today are Andrew Aldridge, Partner, Head of Marketing at Deepbridge Capital. Hi, Andrew. We have Mark Brownridge, Director General of the EIS Association, John Glencross, Founder and CEO of Calculus Capital, and Harvey Shulman, Director of Seed Mentors Entrepreneurs. Welcome all of you. Let's set the scene. This webinar is going to focus more on enterprise investment schemes, but when it comes to tax-efficient investing, I think it's fair to say our audience may be more familiar with venture capital trusts. So perhaps could we start off by comparing and contrasting the two areas? Who shall I kick off with? Any volunteers? John?
Well, thank you. I think the whole tax-efficient investment area has gone through incredible change in the last 2 years. It started really in November 15. With some very significant changes in that budget, and one of those very significant changes affected VCTs, which they were no longer able to do MBOs, because most VCTs, in fact, historically, have been investing in smaller MBOs. So they were, from that point, forced to look at growth investing. And then, of course, we've had the very significant changes in the budget that's just gone. So VCTs, EIS, we're actually all investing in the same pool of investments, growth investments. I think whether a VCT or an EIS is more suitable for an investor really depends on his or her situation. I mean, obviously a VCT, you invest in a company which invests in the underlying investments, and the main tax reliefs are the 30% upfront income tax relief. And then obviously the tax-free dividends. With EIS, there's a much wider range of tax reliefs, including upfront income tax relief, but capital gains tax deferral relief, etc. So it's really very much what suits the individual investor. One of the big drivers for EIS is, in fact, inheritance tax recently. But it's really, they're all investing in the same pool of investments. Which set of tax reliefs are more suitable for the investor? And that's really, I think, something for the advisor to discuss with the investor.
I think we're going to get onto that and try and give the advisors some pointers there. Now, rather than, I'm not going to work my way down everybody for each question, so do feel free to pile in whenever you like. And in the same spirit, do send in questions. This is all interactive, and I will try and read as many as I can. I've got a few have come through already, including will any slides from the webinar be made available subsequently? There are no slides for this webinar, so you're safe on that one, but we'll try and do some coverage on, well, we will do some coverage of Professional Advisor, so that will be at least in some tangible form. CDISs, where do they fit into the picture? Who's going to take that? Yes, Andrew.
I think we provide seed enterprise investment scheme opportunities and enterprise investment scheme opportunities. And I think where seed comes in is, as it says, at the very early stage, the seed stage ideas. We've seen, particularly as the market, as John said, has moved towards growth companies, we've seen a number of EIS providers maybe invest earlier than we normally would, and they're almost investing under EIS at seed stage where we would consider seed to go. So I think, particularly from an advisor and investor point of view, when you're looking at investment managers, you should understand kind of at what stage they're investing in companies. Because from our perspective, we separate the two. So we have our CDIS for that very early stage, extremely high risk kind of idea stage. And then we have the EIS, which comes in when a company is actually showing commercialization, is showing that it's got commercial revenues coming in, etc. So you're actually going at a later stage, which we believe helps mitigate some of those early risks that you get at seed stage.
Just to chip in there.
Of course.
Obviously that's all correct. The only point I'd make is that on SEIS, the tax breaks are higher, 50% and even more if you put a capital gain in. The risk profile, of course, is very much higher. And the SEIS market tends to cater for individuals who may get together to promote their own company idea. The VCTs tend to be more professional in terms of management. The fund manager has a more active role in my experience. the EIS and certainly the seed areas tend to be more liberal in how the companies are run and more, perhaps quirky is the word. So it's horses for courses. Some people like the greater element of control that you might get in seed, but if you want highly professional management with the extra costs, obviously, then a VCT might be more to your liking.
Although that actually very much leads on to the sort of question I was going to ask next, which is, I mean, John's alluded to it as well, is do the different products or vehicles, whatever you want to call it, suit different types of investors? For example, income seekers, and I'll bring you in here.
Yeah, I was going to say, I kind of look at it from the other side of the fence in terms of the companies themselves. So in terms of a company's funding journey, it tends to go a little bit like that. So you kind of seed EIS is generally your early stage funding that goes in very much when you're starting off. Then you might graduate onto EIS funding when you need the next round of funding. And then so on and so forth through VCT and through your sort of A and B rounds and perhaps onto AIM or onto an exchange. So from a company's point of view, it's quite easy to go on that journey. I guess then from an investor's point of view, as Harvey says, it's really just trying to match your risk and your reward. So CDIS is very much riskier. But you get a trade-off there because you get 50% tax relief rather than 30% with EIS and 30% with VCT. So I guess going along that journey line, there is something for everyone investor-wise. You want something really early stage, really innovative, really disruptive. You want to be CDIS, and then you can kind of go up the scale in terms of risk and reward.
I think the key thing is understanding where you're investing on that road, if you like, on that journey. You know, is it where, how risky it is, how early stage the investment is.
Well, can we maybe try and sort of gauge how that is? I mean, I know it's a piece of string here, but you know, and I'm not going to get into risk metric type numbers, but in terms of say UK smaller companies, riskier than that, but much riskier? Or?
I would say they're considerably riskier. Right. I mean, the reason that the tax reliefs are higher is because the risk profile is higher. And I think anybody investing, whether it's SEIS, EIS and VCTs, the important thing now, particularly since the budget, is to understand the risk profile that applies to all those different types of investing. SEIS is very binary. You may have a very successful investment, but the probability is you will lose your money, which is why the loss relief is quite substantial in that situation. I would say do not look at SEIS on the basis that the tax breaks look attractive, because the tax breaks are there for the very specific reason that the investment profile of very early stage companies is very, very, very high. It's a very high risk situation. If you wanted a rule of thumb, you're probably looking at SEIS level 1 in 20 investments success, likely to pay off. And you know, that has got to make up for all the others. Yeah. If you're looking at EIS, I think depending on where EIS covers a vast range of different investments. But I think if you know the risk profile there is less clearly than SEIS. If you wanted a rule of thumb, and rules of thumb are clearly dangerous and often misleading, I would say that you're probably looking at 1 in 4 or so. The important thing is always to have a portfolio. Do not have an investment and think you've got, you're doing well. The important thing is to have a portfolio. And then if your risk appetite is not even appropriate perhaps for EIS, well then a VCT is appropriate for that investor. A VCT will have a portfolio of 30 to 60 investments. And therefore the failure of any one is unlikely to dramatically impact the overall performance of the portfolio. But if you are looking at SEIS, remember that the tax reliefs are there because it is very high risk. It is often binary, and to have an investment, the probability is you will lose your money. So if you are going to be in SEIS, do it in a way or with somebody that is able to at least give you a portfolio and a sensible spread in that portfolio. SEIS, still, it's risk capital. It is equity risk capital for early stage businesses, but less risky than SEIS, and probably ranks ahead of a VCT simply because of the structure and the size of a VCT portfolio. The important thing is that the investor understands, this is the very important thing, I think, since the budget, that the investor understands what the risk profile is applicable to whatever stage he or she is looking at. Particularly now since capital preservation, which was such a major part of the market, particularly for EIS, has gone. That has gone. It is growth investing now, but growth investing can have very, very different risk profiles depending on where you are, as Mark said, in the development of that company.
Okay, and
Can I just
of
chip
course
in
you
there,
can. Yeah,
because,
please.
Obviously, this is an area, the SEIS area, where I've been closely involved, and my experience has been perhaps different to what you would have expected at the beginning. With other startups that we've funded, we've probably invested in about 70, 80 companies, and none of them have, inverted commas, failed. They're all still trading. The view I have, which may be a bit unusual, is I don't think there's that much difference between EIS and SEIS on a risk basis if the due diligence that you're applying to the companies is done at a reasonable level. I think the changes in the budget are going to make for a more level playing field between EIS and SEIS, simply because the safety first routes that were adopted by EIS are no longer possible. I do accept the risk in SEIS is much higher, but I think the risk can be overstated. Most of the SEIS fund operators do go for a portfolio approach now. You can get, as I've said, the quirky one-off special situation which bucks the trend. The thing about VCTs is if you want income, VCTs obviously have a more efficient profile than, say, EIS or SEIS. But in terms of risk, I think the risk can be overstated. I do agree that for SEIS or EIS to make progress in the long run, they need money. And that's why the progression of the SEIS, EIS companies end up eventually going for VCT money to make their initial concepts work. But most of them, or a fair number of them, will get to the level where they can apply for VCT money. They may not get it, but most of them get through to the point where they can think about it.
Okay, but and so I guess from an advisor point of view, as long as the client's going in with their eyes open, that's the key priority. I mentioned income at the start. I mean, is there an income element to this that would obviously the hunt for income has been an ever-present theme of the last 10 years or since the crisis and low interest rates. Is this something that the sector can serve reasonably well?
Well, VCTs, one of the main tax benefits is tax-free dividends, and most VCTs will aim to pay a regular tax-free dividend. Some are semi-annually, others maybe just annually, but the average, and it is tax-free, and it is obviously significant for a higher rate taxpayer. I think the average dividend is around 5%. So I think that is obviously a big draw for VCT investment. VCTs are able to do that really because of the size of their portfolio, because they have to do it out of profits. But obviously if you have a large portfolio with reasonable turnover of investments and you are running a sensible VCT, you will be generating the profits that you are able to pay regular dividends. And in fact, I think there are very few VCTs that do not, commitments are hard, but I mean most VCTs will say intend and actually deliver, paying a regular tax-free dividend of around 5% per annum.
I think from an EIS perspective, particularly in the growth world that we now live in, is that certainly our EISs and our SEISs, we don't expect them to return dividends to the investor. Right. As John said, dividends have to come from profit. So most of our invested companies, before we get to an exit, won't be profitable. They'll be generating revenue, but they won't be at a position where they're paying dividends. It's all about the growth and the capital accumulation that they're looking for.
You pay tax on any dividends that an EIS investment pays. So I mean that is, and that also they are growth companies. They are unlikely to be particularly generating income, and if you do pay tax out of dividends for EIS, that is taxable in the hands of the investor. So that is a disincentive for EIS to pay dividends. EIS tends to be about longer term capital growth.
Okay. Again, because they capital growth, CGT exempt on any growth that you get in the US.
I think one other point just worth mentioning is on exit routes. On the whole, the VCT exit route tends to be a bit longer than the SEIS route, where in theory after 3 years you can look at your exit situation. In reality, I think SEIS is probably now a 5 to 7 year play. I don't think many people would think an SEIS company can get to a stage where you can make serious money in 3 years. EISs, I suspect, may well be that sort of level as well.
Okay. Well, I've seen EIS and VCTs described, actually now I come to think it very possibly by Andrew, as the third pillar of tax efficient investing after ISAs and pensions. Do you agree? Presumably Andrew does, if he did say that. If so, why is that so? So what was your thinking?
I think I probably stole it from Mark, to be honest.
Okay, fair enough.
But no, I think certainly, advisors are looking for tax efficient places to place investors' money. Obviously there's limits on pensions, ISAs are a great home, but when you actually think about government policy, pensions are there to encourage people to save for retirement, ISAs are there to encourage people to save, full stop, and EIS, VCTs, etc. are there to encourage investors to invest in small growth businesses in the UK. So it's just a natural cycle of government policy and government thinking.
Okay.
I think particularly for IFAs, I used to work for an IFA firm, we used to kind of fill up the pension bucket and then fill up the ISA bucket. Also these days it's quite easy to do that with the annual allowance coming down, the lifetime allowance coming down. So EIS and VCT kind of sit as the next tax efficient investment in the row, if you like. I guess a word of caution there, because they do a very different risk profile from both pensions and ISAs. The pensions and ISAs obviously tend to invest into a portfolio, a diverse portfolio we talked about earlier, across many different sectors and areas, and EIS can either be a single company, it can be a fund, so the risk profile is quite different. We always thought when we were in IFA, if you had a 1 to 10 risk profile, which most probably IFAs do, EIS probably sat around 15 or 16 or 17 even. So you need to work out whether it's appropriate for your client and whether, if they've done pensions, if they've done ISAs, is EIS, is VCT going to be appropriate for them?
I would say after pensions, and obviously the lifetime cap has come down, the annual limit is being squeezed, particularly for higher rate taxpayers. After pensions, after ISAs, then EIS, possibly, and VCTs, but they are companions. They are not substitutes. They are not substitutes for either of those. But they are potentially attractive companions, provided that you do it sensibly. I think, as you say, look at a portfolio approach, and perhaps be careful in your selection of whoever it is who is the manager of your EIS fund or your VCT.
Okay. So EIS is definitely, to my untrained eye, appeared to see a bit of a rather boost in November's budget. When the government took the opportunity to respond to the patient capital review, let's focus on that a bit. How would you characterise the aim of the review, starting off? Shall we, John?
Well, I think like many government reviews, it started with one question, which was essentially, why is the UK seemingly very good at funding startups? Because I think there were some OECD figures that said that we were third in the world, in the Western world, but we were 13th for being able to fund scale-ups. Right. And I think the present Chancellor in particular was particularly focused on that. So it started out really focused on scale-up capital. But as is the way, various things were added, one of which was the Treasury in particular was very concerned about the amount of EIS investment in particular that was going into so-called capital preservation schemes. And I mean, their view is they do not give tax breaks in order to invest in rather secure so-called low-risk capital preservation schemes. The other point was interesting because, and it is behind a lot of what actually came out, which was the UK has historically been poor in its productivity growth compared to other Western countries. And I think a lot of what we saw in the budget, particularly the focus to try and give a boost to so-called knowledge-intensive companies, is actually addressing that rather technical point which the Treasury has, that they want to see the UK achieve greater productivity growth. But in terms of the impact on our daily lives, we have always been a growth investor. I think nobody would say we'd ever been a capital preservation investor. But I think one of the big impacts on the daily lives of those of us who are investing, and IFAs need to think about this, was the biggest impact that came out of the patient capital review and the budget, and the patient capital review is very supportive of EIS in the budget, is that capital preservation is off the table. And the focus now is not necessarily on knowledge-intensive companies. They did receive a very large boost within the new rules, but it's on entrepreneurial growth companies. And the Treasury is very committed going forward, and this was really very strongly supported by the patient capital review, that they give tax reliefs in order that money will flow into promising smaller growth companies. And they're very keen, and I think that is the way the landscape has changed now. That is the environment we are in, and that is very much where the Treasury has repositioned the whole investment arena for EIS and VCTs. Historically, half of EIS was thought to be capital preservation, and you can understand that the government would feel that they weren't giving the tax breaks for that purpose. And actually there was another point that was made by a former former cabinet minister who made a very good point, which he said, remember that this government is desperate to see itself defined as supporting the just about managings. Therefore, if they looked at the EIS and VCT investment and saw it was all about, or so heavily focused on capital preservation, they would feel that they were very open to criticism of tax breaks for the wealthy. And indeed, that would be a logical conclusion. So, that is why in the budget there was a very determined attempt coming out of the patient capital review to reposition EIS and VCT investment as clearly supporting promising growth companies. And one of the big things I think that everybody has had to adjust to in terms of the advisory market is that capital preservation, which was very much part of their planning, has gone. Okay. It has gone.
So I think ultimately the other thing from government perspective is they want return on investment themselves.
Yes.
If they're giving £1 of tax relief, then they want to make sure that's, and how do they get that? That's from job creation, that's creating exports, and that's creating innovation efficiencies within the economy.
So, well, I think that actually, so you preempted one of my questions, which is what consideration do you think drove the government's response? I think that's pretty well covered there. What are your own reactions to the government's response? How did you take it? I mean, Andrew.
From our perspective, it was great as far as we were concerned. It reinforced what we were doing. We specialise in investing in technology companies and life sciences companies, so very much the knowledge-intensive area that the government was looking for. It's interesting to see that a number of our peers in the market are now quickly reshaping themselves as tech experts. So I think there's that going on in the market. But from our perspective, we were very pleased with it. Business as usual as far as we were concerned. Thankfully, we didn't have to change anything we were doing. So yeah, from our perspective, it was a reinforcement and an acknowledgement from government of the good work EIS does.
Okay, Mark.
Yeah, I think from our point of view, it's pretty clear the conversations that we've had with Treasury and government, because we had quite a few over the sort of preceding months from the patient capital review. That there's three key things they wanted to get to: is innovation, tech, and growth. They were always the three key words that they kept coming back with. So the challenge for us then was to try and mould or shape EIS to fit in with that vision, if you like. So it was pretty clear a couple of times that EIS was under attack, that the tax reliefs, as John has said, were perhaps going in the wrong direction. They didn't want to give tax relief to companies that they feel whilst maybe deserving and were employing people or making revenue, weren't actually growing or scaling up or making those small companies become really big companies, which is what they want to get to. So the conversations we had with them were trying to kind of push us down that line to help us sort of clarify, I guess, really where they would like us to invest and where they don't want us to invest. So I think that's what the patient capital review and also the industrial strategy, thinking about that as well, that's what is really done for EIS now, is really clarified the landscape. We all know which direction we're heading into. You might not agree with it, you may do, but at least now the vision is there, it's in place, and we can all work towards it.
Okay.
I have a slightly different take on this.
Well, we're spotting a theme here now, so that's good.
That the theory is understandable and everybody signs up to it, but the actual practice at the moment is unknown, and there are certain systemic difficulties in the system which would act as a brake on people going forward with EIS and SEIS ideas that they want funded. For example, the time it takes to get clearances, the number of people in the Inland Revenue who are trained up to give the clearances, the sort of objections that come forward that you have to deal with, which can make the process seem endless and effectively destroy the desire of people to carry on with ideas that come to their mind. So I'm not convinced how much growth there will be, how many people will want to go through the process, how much approval there will be, because it looks to me like the Inland Revenue inspectors who've got to make the decisions now are being left with a very subjective task of deciding whether you're in a growth bracket or not, and there seems very little opportunity to actually challenge any particular decisions they make. So, Mark.
Yeah, I agree with you. I think because the government has committed to getting advance assurance down to 15 days, I think it is from memory. So yeah, that's a real challenge. We meet some EIS funding companies that said it takes 14, 16 weeks to get an advance assurance. And for anyone who doesn't know, advance assurance is basically HMRC ticking the box of saying that you can qualify as an EIS qualifying company.
So pretty important in the process.
Yeah, I suspect part of what they're trying to do, HMRC, with refocusing back onto growth is, as John says, a lot of the applications they get in are one, speculative. So companies just put in advance assurance, it never goes anywhere, it gets assurance but doesn't raise any money. So they're trying to move some of those away. And also the capital preservation stuff, also they're trying to move some of that away as well. So I think their thinking is that if they can remove some of that from their workload in their system, the growth ones will come through and power through more strongly, and they'll have more time to do those advance assurances and get them out quicker than perhaps they are at the moment. But yeah, I accept it's going to be short-term pain for a long-term gain, I hope.
The other thing I would say is that the market for SEIS and EIS, it's largely driven at the moment by fund operators who put out documents offering you this spread of risk, hopefully, be it in tech or anything else. But it takes a lot of time to put these documents together and effort, expense. If you have difficulty knowing how long your clearances are going to take, then people who come to you for money, who want to be included in your potential investment list, it becomes more difficult to know whether they will get their clearances in time, what will be accepted, what won't be accepted. So I think one of the effects of this review may be to restrict or even drive out some of the fund operators who are doing this, simply because of the sheer difficulty of putting funds, as it were, together. And I think the government is trying to go down more to the individual groups of people who want to promote their own particular company rather than the mass-marketed version of this.
I think, I do think, however, you're being a little negative. I would say that the advance assurance process is an issue. For us, it's running at about 10 weeks at the moment, but I have heard of a lot longer. But as Mark said, the aim is to bring it down to 15 working days. I think that is a bit of a stretch goal. But to have it come down to less than it is at the moment would be progress. We build it into it takes about 4 months for us to make an investment because of due diligence, documentation, etc. And we build that into our process. I think advance assurance is an issue. I think the budget is actually given a boost to growth investing. I think as I look at the market now, I suddenly see a lot of VCTs that were MBO investors frantically trying to increase their teams to be growth investors because they are different disciplines. One of the things is that VCTs have raised very large amounts of money. They are sitting on money that they have raised in the past. They're raising large amounts of money this tax year, and they have had some exits as well. So they have an awful lot of money to put to work, and they're scrabbling to try and build the teams to do that. So I think a number of VCTs will have a particular challenge going forward, and I think that will have some repercussions for the investment market. I think for those of us who have been growth investors throughout, we're seeing actually quite a strong flow of investment opportunities. There are themes to those investment opportunities. Yes, we have to take into account that HMRC has 15 inspectors. That's not 15 full-time equivalents, that is 15 inspectors and some support staff who give advance assurance on all of these investments. And the investment rules are complicated, and it's unlikely that anybody should go forward without having got advance assurance. I think, though, that the opportunity, the opportunities are there, and we're a very buoyant economy at the moment, and there are a very large number of companies out there seeking capital for the right sort of reasons, growth and development.
I think from the advance assurance perspective, just very quickly, I think from an investor and an advisor's point of view, it's just to make sure that any fund you're working with, one of their criteria is that advance assurance is in place before deployment. We've seen over the years a few where it's gone wrong, but if that's a key criteria that has to have advance assurance, then actually that's our problem rather than investors or the advisors.
Okay, we'll have to, if we have a sequel to this, we'll come back to the advance assurance angle, but I just wanted to move things along because I'm conscious of time. These things always take speed along once we're actually getting in the swing of things. One of the key phrases from the budget and the review was knowledge intensive. Can you talk us through what that means, the implication of this switch and focus for the EI sector? Is that, Andrew, is that yours?
Yeah, sure. I mean, back in 2015 when government came out with the term knowledge intensive, they put in some quite straightforward guidelines about what knowledge intensive means. So they've got to have a certain percentage of their turnover or their operating cost in the last 3 years has got to be on research and development, and they've got to either be developing intellectual property, and that's going to be a core focus of the business, or they've got to have higher education qualified staff making up over 20% of the business. So from our perspective, again, technology and life sciences, most of our companies, if not all of them, will qualify as knowledge intensive, which ultimately means, since patient capital review, that we can put more money into those companies at a quicker rate, which means you can scale up quicker. So the limit of you can put into a knowledge intensive company per annum going forward will be £10 million rather than £5 million if they're not knowledge intensive, which means that, again, it's trying to get back to government's initiative of trying to encourage scale up and making sure you can scale up quicker.
Okay. I've thrown at the same time as you addressing knowledge intensive, I'll throw in life sciences as well. John,
well, a lot of life sciences companies are knowledge intensive.
Well, I mean, I was hoping that was going to be the case.
I mean, essentially, most companies, I think, qualify as knowledge intensive on the basis that of the amount of R&D expenditure that they have, and that they are developing often intellectual property. I think one of the messages that may have come out of all the discussion about the budget is that it is all about knowledge-intensive companies. I don't think that is strictly accurate. Actually, the focus is on entrepreneurial, smaller entrepreneurial companies, not necessarily knowledge-intensive companies. And you can have companies in areas such as, leisure, media, who are very, very entrepreneurial, very growth-orientated, who are very deserving of investment, and the budget was very supportive of those companies receiving investment. It is true, it did give a particular boost to knowledge-intensive companies in terms of amounts that they can raise, but also the timescales that they can have existed before they raise capital. But it's important, we are so rich in this country in terms of those companies. We've all heard about Silicon Roundabout now, and all the tech that we have. But we are incredibly rich in this country in terms of the whole life sciences area. And I don't just mean drug discovery, which is a particular risk model. But there is a huge amount happening in the whole area of life sciences and healthcare, often bringing together technology and science. And it's interesting, when I've talked to a couple of successful life sciences companies recently, that you find actually they started life as tech companies. Yep. So, I mean, we are incredibly rich in these opportunities. I think we don't understand how heavily our universities punch in terms of what they're producing. The government gave a particular boost to knowledge-intensive companies, which are which are the far more technically or scientifically orientated. But actually, the budget was intended to boost investment into entrepreneurial companies in general, and there was a particular focus on those companies. But it was about ensuring that deserving entrepreneurial companies received investment and removed once and for all, to say that, capital preservation opportunities.
I think you're spot on with life sciences, and I think in terms of life sciences can mean anything from drug discovery to biotech to medical technologies. A big area that we're seeing, exactly as John said, is around digitalisation of healthcare, the kind of cost efficiencies that go along with that. I think the thing we always say about life sciences is that if you are thinking about life sciences as an investment kind of sector within EIS or whatever you're looking at, is make sure you're investing alongside people that have been in that sector before, understand it, because it is fundamentally different to any other sector that you'll ever invest in. You know, whether that's from valuation at the outset, how do you value a drug discovery company? Some drug discovery companies, for example, will never make a penny of commercial revenue during the lifetime of your investment, and it's only on exit and sale that they actually make some commercial revenue. So understanding that market, how you value it, how you manage it, and ultimately how you exit is crucial to have that sector experience.
There are two very different models in life sciences. One is, as Andrew said, what they would call the therapeutic, which is essentially drug discovery. And I mean, if you are researching, say, a cure for a particular cancer, and there are some remarkable advances being made in all of these areas, that is the risk profile of those investment opportunities is quite steep, and the timescales are very long because of the regulatory process you have to go through. But if you have a successful company, you know, and it has a multi-billion potential selling drug, you're going to have a very successful investment. But there is a different model again in life sciences, which is what we would call the non-therapeutic, which is all those companies which are providing services in terms of, we have a company that provides cell lines to research companies and pharmaceutical companies for their research. We have other companies who are involved in the provision of digital healthcare. Those are a very different model from the drug discovery model. They are closer to a more traditional growth investment model. There are opportunities in all of those. I think I would counsel against being too heavily invested in drug discovery, because you may have quite an exciting ride, but it will be a roller coaster ride. And it'll be a long one before you're likely to see returns.
So just to make one point, that the EIS and SEIS market is not all about life sciences and knowledge intensity.
Well, I was going to actually bring you in with that very quickly, actually, because I couldn't resist John mentioning British universities punching above their weight. So that was, to show the spread of it, was yours is not knowledge intensive, one of your specialist areas, boxing. You know, why go into that?
Well, boxing is an example. We've invest in things like estate agents, catering companies. There is a whole world of industry and business outside life sciences, and no sense do I say that sort of investment isn't good, but there is an enormous world outside life sciences, and there are traditional businesses which, as you correctly say, they're entrepreneurial, the people behind them are very entrepreneurial, but not everybody is into knowledge intensity. There's a lot of people who have traditional businesses which they wish to progress in an entrepreneurial way, and you do get the more unusual. I mean, as you mentioned, the professional boxing, that is definitely not knowledge intensive, but the people who are in the professional boxing business, as it were, they have to be entrepreneurial. So we need to remember there's a whole world of activity that is outside scientific discoveries. Although they offer great rewards, there are lots of other things that people do, and they do qualify for tax relief.
Okay, thank you. I'm going to I'm conscious of time. There's a few practical questions. I've got I've got coming through here. Is it fair to say there's a lot of cash now chasing the same type of opportunity? We've been talking about diversification here. If so, are EIS and VCT managers likely to be overpaying for investments in order to put cash to work? Do you expect to see fee pressure for VCT and EIS managers? Somebody throwing the cat among the pigeon there. Anyone want to pick up on that?
Sure. I mean, it's a valid point. I think John touched on that briefly earlier. From our perspective, we don't see much competition from VCTs and other EISs in the marketplace. Majority of investee companies that want us to invest in their business come to us because of the team that we've got, the mentoring, the hands-on management we give them, etc. So people come to us for a reason. We've got great deal flow, we've got great connections, and those companies that come to us aren't touting out to anybody to get investment. They're coming to us for a specific reason.
I would agree with that. I think the fees are not as important as the people who are actually doing the investment, because if you're going to give a good service, it takes people's time, labour, effort, and you can't cut corners. And therefore, if you want the service, you've got to be prepared to pay for it.
Okay. Got a couple of platform-based questions here. Let's presumably platforms will assist the advisory market in gaining access, assisting and removing the administrative burden, whilst helping mitigate some of the risk. Question mark made that into a question at the end. What are our thoughts on the platforms? Mark, is this a good development?
Yeah, I think so. Yeah, I think obviously we've seen, again, in proper financial planning world, we've seen the Transacts and Fidelities come through and they've had platforms and they've simplified everything and they make the administration a lot easier. I think EIS particularly has been going on 20 odd years and it's still quite a cottage industry in that sense. So we still need some technology and development in terms of the way we invest in EIS. So it would be good to see some more platforms, some more technology, exactly what EIS is all about pretty much, in that area, and some development to try and help IFAs to try and get a better view of where the ERSs are and how they can invest in them and do the administration around them.
There are some good platforms coming through.
Yeah, absolutely. Yeah. In the last couple of years, there's been 2 or 3, so it's good to see.
The different considerations from so we mentioned the Transacts. Do advisors have to think of it in a slightly different way, or is it the same when assessing a funds network or a co-funds or whatever? That it's the same with this new breed.
A little bit, yeah. So I guess they're trying to do the same thing. They're trying to centralise everything, bring it all together under one platform umbrella, if you like. So they're different to the Transacts and the Fidelities, and obviously those guys can't do EIS and VCTs, or and the Transact can do VCT actually, but on the whole they generally can't cope with EIS and VCT. So, and it's always different for an IFA. I know when I was an IFA, we used to have 6 different systems of 6 different type of things. So adding another platform can be tricky sometimes. But in terms of what we're doing in the EIS and VCT world, I think it will really help a lot of advisors. 1 with the education side of it, and 2 with the admin side as well.
Okay. I've got one on, again, what is the view of the panel on the new key information documents that are now a requirement? Do they add or complicate the recommendation of an EIS, CIS or VCT?
I think from our perspective, the key information documents, we understand why they're there, we understand the rationale behind it. Whether they really fit in the EIS market or not, the information isn't quite as linear as for other propositions, etc. I think we've already seen some advisors and some of the large nationals and networks questioning actually the value of kids for EIS, etc. So, whether they're here to stay or not, obviously they are regulatory wise, but whether that changes down the line, because actually they're not particularly the document that people should be going to compare.
No, it's a bit of an issue for every investment at the moment. I think it's not just related to the visa tax efficient sector.
I think it's very early days for kids. I think there's quite a range of ways that things are being calculated, that fees are being calculated within putting the documents together. I think it's going to take a while for the smoke to clear, really. Maybe in 18 months down the line, when there is greater standardization in how people are addressing putting their KID together, their key information document, they may be more useful. At the moment, I'm not, when I talk to advisors, getting particular feedback that they are important for them at the moment, but we are 2 weeks since they were introduced, so it may be a little early to form a view.
I think advisors are more keen to have your Allenbridge or your Churchill or your MyCap or your Hardman & Co report as an independent review rather than a KID. I think that's more important to advisors in our sector.
And I think one of the things that people have touched on with EIS and VCTs is know your manager. The important thing is know your manager, know what they are doing, know what they have done. As we've said, we've talked so much this morning about growth investing. Make sure that the manager, whether it's an EIS or a VCT, that their track record was based on that. Absolutely. Because a lot of track records out there at the moment are actually based on a very different type of investing.
Absolutely. Absolutely.
So I would say that one of the key information documents have a place, probably will have a greater place as we go forward, and they bed down. But for anybody, whether it's a direct investor, whether it's an advisor, do know your manager, do look closely at what they have done, how long they've done it, how long their team's been together, and are they in fact, is their experience based on what they are now going to be doing going forward in terms of...
It's difficult for...
I'll just say, because you've all managed to be spookily prescient of every time I'm about to ask a question, you answer the one just beforehand, and that's very two Ronnies. But anyway, so I think as we wind up, this will be my final question therefore, and I will let each of you answer it, because it was the practicalities, whether it be due diligence or the practicalities of it. What should, and John's actually probably been through a decent checklist already, but what should advisors look for considering an EIS or VCT provider, and are there any particular questions they should be asking to ensure that they've got a suitable home for their money? And Harvey, you're next to me, and then we'll work our way down the line.
I think the points that have already been made are the sound ones, that you look to see how much experience your particular manager has had in the sector, and as has been correctly said, how relevant is that experience to the current market?
Yeah.
And I think those are key factors which probably would apply to everything.
Okay, John, thank you.
I think a number of, particularly VCTs, it's interesting, their teams were developed to do a different sort of investing, but the EIS, the people who historically have done capital preservation, they're all still in business, and they're all suddenly trying to become growth investors. So actually there is a frantic recruitment process going on at the moment as some funds try to increase their experience and the number of people they have in their teams. But I think look to see how long that team's been together. Look to see what that EIS or VCT investor was doing 3 or 5 years ago in terms of the type of investment. And if they were doing a different sort of investment, I think question how suitable that team is in terms of investing in the sorts of investments which are now the mainstream of EIS and VCT investment. Whether, as Harvey said, they are knowledge-intensive companies or many other deserving entrepreneurial companies. But I think it's really one of the big things now is what is the experience of the manager, VCT, EIS, SEIS as well, but that's obviously a rather slightly different area, in terms of the sort of investments that we are all going to be making going forward. Because it's not just experience. If they have been active in that area in the past, they will also have their own established lines of deal flow.
Yes.
And yes, it is getting more competitive out there because there is more money looking for a home. VCTs in particular have raised very large amounts of money. So there is a lot of money out there. That is, anybody with basic knowledge of economics knows that's likely to affect in prices for investments. So you really want a manager that has experience in the area, and that experience has allowed them to develop some proprietorial deal sources which are not just based on how much money they've got, but on what they can bring to an investment situation.
Brilliant, thank you, sir. Mark?
I expect we're all going to give the same answer.
Well, that's fair enough, but it's high. I appreciate it's harder as you get down the line. Andrew, yours is going to be...
I've got a good one.
Yeah, no, I was going to answer the question slightly differently, hopefully succinctly as well, to give Andrew a bit of time. But so one of my bugbears for the industry is trying to compare both charges and performance across EISs and VCTs as well, actually.
Right.
It's really difficult for IFAs and financial planners. Mm-hmm. There's no conglomerated way to do it. Most of the researchers don't do it. There's no industry standard like we see again with portfolios in the IFA world. So, yeah, one of my challenges really to the industry is there one way we can come up with being able to very quickly, very easily compare and contrast both charges and performance. I think it's a bit of a nirvana. It's something we need to aim for over there. We may or may not get there over time, but it's certainly something we as an industry need to get there, because when I speak to IFAs and financial planners, and we've done quite a few roadshows this year, that's one of their biggest bugbears. They're not looking at this stuff all the time. It's perhaps 5-10% of their business. So they want to very quickly, very easily be able to compare and contrast, choose an EIS and on they go with the recommendations.
So, Andrew, it's a good one. No pressure.
I think that there's two things. John touched on one, which was about where companies are getting their deal flow from, and I think understanding how companies do that is important, because ultimately that will determine the quality that people are going to be investing in. And secondly, once you are assured that they are getting quality deals coming in and they've got those criteria in place to make sure there is quality investors investing in, is actually how quickly they're deploying funds. Back in the dark old days of EIS, if you like, many moons ago, it used to be you put your money in, it went into a black box. Probably end of the tax year, you'd suddenly get some share certificates through. That's the first time you knew what you're investing in. So understand what you're investing in, but also understand how quickly you're going to be deploying. So is it going to be deployed this tax year? So can you utilise carry back to the previous tax year? Is it going to be deployed within the next 6 weeks, in the next 12 weeks, whatever that might be? Because ultimately, if you're not deploying funds for 2 years, as some of our peers now promote, that if you've got a 3-year clock ticking on EIS anyway, that's 5 years before you can even consider an exit. So all those kind of things. I think speed of deployment, as long as you can assure the quality, is an important question to be asked.
Thank you so much. I'm going to wind it up there. It seems to be running out of time. I'm very conscious of the time here. We'll try and get everyone back for a second go. I'm conscious I haven't answered all of your questions. Thank you for everyone who sent them through. Most appreciated. Gratifying amount of questions here. Done as many as we can. Just got to wind up with my thanks, of course, to Andrew, to Mark, to John, and to Harvey, and of course to all of you for watching. Thank you very much for your time. I hope you'll join us again soon.